Welcome everyone. In today's video, Infinancy is going to explain what the term debt capital markets means. Let's start with the definition. Debt capital market, shortly DCM, is a market where companies and governments can raise funds by trading debt securities such as corporate or government bonds, swaps, and other similar instruments. Debt capital markets, DCM, also known as fixed income markets, are low-risk capital markets where investors are lenders to a company in exchange for debt securities. These markets are also used by companies to finance themselves through debt, which helps diversify their funding. The term is often closely associated with equity capital market, or shortly ECM. However, the major difference between DCM and ECM is the type of investing activity. For example, in DCM, investors are lending money to companies, whereas in ECM, investors are purchasing a portion of ownership in a company. These two different investing activities lead also to very different levels of risks and rewards. With debt securities, investors are offered a fixed coupon rate, which is why the market is sometimes referred to as the fixed income market, and because of this, it has a lower return on investment when compared to equities. Why invest in debt capital markets? Well, debt securities provide an income stream, and hence the name is also fixed income. And such instruments are particularly attractive for risk-averse investors. Debt capital markets are groups responsible for providing advice directly to corporate issuers on the raising of debt for acquisitions, refinancing, or existing debt, or restructuring of existing debt. These teams operate in a rapidly moving environment and work closely with an advisory partner, the Investment Banking Division, or shortly IBD. Being part of such a team means being extremely up to date on fixed income markets, including bonds, treasuries, money market instruments, and more. Investment banks help companies borrow money by issuing bonds or IOUs that are sold to investors. The company must pay the prearranged rate of interest, but it doesn't give up any ownership of the company. That's all. Thank you for your attention.